Hello, and welcome to the Bull Truth's online tutorial for what makes for an efficient investment portfolio. I'm Tad Griffith, the author of The Bull Truth, How to Tell When Your Financial Advisor is Lying and Never Let It Happen Again, available at bulltruth.com. This tutorial is a short one designed to introduce basic investment theory. An efficient portfolio is one that performs as desired, and it is a simple math equation that a lot of financial advisors like to pretend is more complicated than it is. But all the fundamental investment theory you need to know when you are starting off with your financial advisor is based on something called the efficient frontier. In the 1950s and 60s, a group of wicked smart economists started investigating what made for an efficient investment portfolio. What they discovered would earn them several Nobel Prizes in economics. They called their discovery the efficient frontier. The chances are good that you believe that the higher your risk, the higher your return should be. Most people think that if you invest 100% of your money in bonds, your risk would be at the lowest it could be. And if you invest 100% in stocks, your risk would be the highest it could be. While that seems pretty reasonable, the truth that the wicked smart economists discovered is that over several years, your risk to reward looks like this. So where most people thought investing in 100% bonds was the least risky investment you could make, the reality over long periods of time was that you could decrease your risk and increase your return by investing in less bonds and more stocks. It turned out that roughly 25% stocks and 75% bonds is the least risky investment mix you should have over a period of several years. What's more, these very smart men figured out that you could maintain the same level of risk over time and increase your return even more. That resulted in a lot of financial advisors telling their clients to go ahead and invest roughly 50% of their money in stocks and 50% of their money in bonds. Today, most people invest even more of their money in stocks. So what do people call the efficient frontier? They call it buy and hold. And if you have any experience investing between 2001 and 2010, you probably know that buy and hold is not the end-all of all investing. The efficient frontier in buy and hold has taken a beating. Why? Because the S&P 500 has barely eked out a profit in the past 10 years. Now many people feel like you need to have a backup plan that can get you out of the market when your long-term portfolio is tanking. In the super volatile global markets of today that are highly liquid and subject to the whim of fat-figured errors that result in losses of 10% or more in less than a couple days, the efficient frontier and buy and hold need to be propped up with some common sense. So you need to have a conversation with your financial advisor. While buy and hold can be a very good thing for you in the long run, you have to talk about what triggers your advisor uses when deciding not to let your investments jump off the proverbial cliff like everyone else's. You want to be sure your financial advisor can identify the indicators that he or she knows what your next move is, including going to bonds, all cash, and/or going to all commodities. If you have spent the time vetting your financial advisor with the checklist from my book, The Bull Truth, How to Tell When Your Financial Advisor is Lying and Never Let It Happen Again, you shouldn't have any problems with them explaining how they will invest your money. If you can remember the basics about the efficient frontier, you'll be able to talk with them at a higher level than most of their clients, and, with a little luck, you and your investment accounts will be treated better as a result. The bare bones essentials of what you should remember are: number 1, an efficient investment portfolio has a mix of stocks and bonds. 2, the least risky investment isn't to invest in 100% bonds over the long run. 3, the least risky investment is to have a mix of roughly 25% stocks and 75% bonds. 4, you need to have the talk with your financial advisor and find out what triggers make him or her pull the plug and go to safer investments. Thanks for watching. This is Tad Griffith, the author of The Bull Truth, How to Tell When Your Financial Advisor is Lying and Never Let It Happen Again, available at bulltruth.com.